So today you have me. My name is Lynn Mucenski-Keck. I'm a partner with the Bonadio group, mainly participate in the tax practice, but also help lead our PPP consulting team, along with Marc Valerio, who is a partner in our commercial practice in Rochester, who will be helping us today as well, who is also a leader in our PPP consulting team. And then Rob Nasso, who's a partner with the Bonadio group as well, and our healthcare tax exempt, and again also helps lead our PPP consulting team. And so we're very excited to share with you what we've learned so far regarding the potential COVID relief bill. If you have been following this, you probably were as excited as us to see that Congress, Democrat and Republicans were able to reach an agreement. They did stall out a couple times last week, which made some of us nervous. But they did indeed pass on December 21st with strong approval this COVID relief bill we're going to talk about today. However, you might also be aware that as of last night, the president has made a statement and has pushed back on Congress, mainly regarding the stimulus checks that will be issued to individuals across the United States. We'll tell you what the current bill says now. We are aware that there's support for it to be increased, essentially for an individual to go from $600 to $2,000 by the president. Nancy Pelosi has said she supports that as well. So we will have to see indeed where that ends up. So as of this point, we just want to be clear, the bill itself has not been signed by the president. If the president does veto the bill, Congress would need to override that veto before January 3rd, which would be before the new congressional members come in. In addition, I would point out that they are going to be back after Christmas to veto an already existing bill, so it may be possible that that could occur as well. So I know it's tough. I know a lot of people are trying to plan, but we do have to be patient to see what is the final bill. Again, the contention seems to be only over the stimulus given to individuals. So if we go to the next slide.
In this part of the bill, obviously there were 5 bills included in the total package.
Yes.
There's a lot of contentious stuff across those, but on the COVID relief side, the big sticking point is the stimulus, the payments.
So I think Marc raises a great point. If you have opened the bill itself, which God bless you if you have, like we have, it's over 5,000 pages. There's a lot of different bills included in the bill, not just this specific COVID relief. It's sometimes hard to decipher and get through it. So all of it is not related to the COVID relief, I would say, of the 5,000 pages. And today we're focusing on the COVID relief package. So the first thing I want to point out is this is the point that President Trump has been contentious with. Currently, the bill states that you will receive a $600 refundable tax credit. Again, it's a stimulus, so checks would go out, as soon as this is passed. Secretary Mucin said early as next week if it was passed this week, which obviously it probably will not. And then if you are married filing joint, that would be doubled to $1,200. So the proposal from Trump is $2,000 per individual, $4,000 for married. In addition, there's $600 multiplied by the number of qualifying children. Adult dependents don't count for that $600. It's really 17 and under, which they're looking for that additional $600. Again, there's modified adjusted gross income, or what we would say taxable income, to simplify it. Limitations, $75,000 for single taxpayers. $112,000 approximately for head of household, and $150 for married filing jointly. For every $100 you go over that, your refundable tax credit would reduce by $5. So the one thing I'd point out is just because your AGI is over $150,000, it doesn't bring you to zero necessarily on your refundable tax credit for married filing joint. But for every $100 over the $150, your refundable tax credit would be reduced by $5. We bring this up mainly, I know we have a lot of business people on the call, but this is a contention point. So we just wanted to explain a little bit more about this particular area. The other item, I know you might say, Lynn, why are you talking about this? I'm talking about it because I come from a family of educators, so a lot of teachers, and God bless our teachers. If you're out there, if you're listening, we all know that they have gone above and beyond this school year with helping our children, including my 3. And essentially, they have put in some language here to help them. You might be aware that teachers oftentimes buy additional things for their classroom, and there's always been a deduction for $250 in tax because of that. And they're looking to expand that to include if teachers indeed bought personal protective equipment or other supplies for their classroom. So when you think about, they might have bought extra masks, they might have bought antibacterial hand solution, they might have bought Clorox wipes, what have you, if you could find the Clorox wipes. And so that's just something as an FYI to let them know that that's a deduction that they could use.
Lynn, question on the stimulus payments. Initially, with the CARES Act stimulus payments, it was based on your most recently filed tax return. If you had not filed 2019, they were using 18. With this one, have they specifically indicated they will use 19 if it's been filed now?
So they said they'll use 2019 tax returns, right, because they're due at this point. In addition, there are people who don't file tax returns, so they said they would reach out to the railroad retirement plans and the Social Security plans to also get stimulus packages to those persons. And similarly, if they had you in the system prior to this because you didn't have to file a tax return but you deserved the credit, they said they would use that information as well.
Okay.
Next slide.
Maybe.
All right. So we have some updates for the Paycheck Protection Program. If you've read anything we're coming out of our tax world, it's really been directed as to the PPP debt forgiveness and whether or not it's a taxable item for 2020. So the background on this, keep it really simple. The CARES Act made it clear that if you took out a PPP loan, so for this example, let's say it was $500,000, that when and if that's forgiven by the bank, that would be cancellation of debt income. But the CARES Act itself said, but we won't tax it. So it would be deemed income, but for tax purposes, we will exclude it. The IRS came out and said, okay, that's fine that they passed that, but then they pushed back a lot through notices and revenue procedures and said essentially, okay, well, even though that cancellation of debt income is not a gross income, all the expenses you paid with that PPP debt, we're not going to allow for tax purposes. And this created a large rub for many of our clients who receive PPP. And so essentially this bill has made clear that the congressional intent, which was always backed up after everything the IRS issued, there was bipartisan notes saying congressional intent was not for the expenses to not be allowed as a deduction, but indeed the expenses to be allowed, and they clarified this in this bill. So essentially what that means is, yes, while my debt is being forgiven, I do not have to pick up that income for tax purposes, but now, even if my debt is forgiven, it has been made clear in this bill, assuming it is passed, that those expenses indeed will be allowed as a deduction. And obviously, you can talk to your tax professionals. We are trying to push our deductions into 2020 right now, and if we're going to get a net operating loss, we want it in 2020. There's a lot of favorable rules surrounding net operating losses, including the ability to carry it back 5 years and carry it forward indefinitely without a taxable income limitation. So this is important. Allowing those expenses to ride in 2020 is important. In addition, they clarified that they're going to treat that income, that cancellation of debt income that's not taxable, as tax-exempt income for purposes of our flow-through entities like partnerships and S-corps, which really has to deal more with our basis calculation. So I'm going to leave that off the table. The one caveat I had here, and I'm not going to get into it, please talk to your tax professionals, the states are different, right? New York State, we know, essentially has said for C corporations in New York State, we're going to follow the federal law, but actually for Article 22 followers in New York State, such as partnerships, individuals, and trusts, they've detached from any act that happens from CARES forward. So essentially what that means is if you're a partnership for New York State, that if you are forgiven that debt, that would be income for New York State purposes, and then you can also take the expenses. Why I bring it up is just be careful. I think that you could see states react to this bill, again, if it's passed, because now essentially in New York State we're going to be penalized depending on our entity structure, which doesn't make a lot of sense, but no one said tax law always does. But just something to watch out on that, once this federal bill passes, we still have to deal with states and their reaction to it. Other things I would point out is there was a lot of movement in the Paycheck Protection Program and adding additional eligible expenses. So you might be familiar with, prior to this, we were able to look at payroll, we were able to look at rent, mortgage interest, utilities. We had a group pack of expenses that we were allowed to spend our PPP funding on. And in this bill, they're expanding those items that you could potentially use your PPP funding on. So here you'll see they talk about operation expenditures. Many of us had to put in money for software, cloud computing, or other needs to make sure that we could get through this pandemic in different situations other than coming to the office. Covered property damage costs. This mainly has to do with property damage due to public disturbances. As you all are familiar, we had some rioting that occurred in our locations, and sometimes that caused damage that wasn't covered by insurance, so that's now an applicable expense. Supplier costs, you can read through that, but essentially it's saying if you had an expenditure agreement with your suppliers and you now were paying for those have potential to also be included as reasonable ways you use your PPP funding. One more slide. And the last covered item that's now included has to do with worker protection. So essentially PPP equipment could also fall into these additional eligible expenses. And so the one interesting part is if you haven't applied for your debt forgiveness yet, you can now look at these items during your covered period. This is not, you're going to find, Marc's going to talk about in a second, that there's going to be a second round potentially if this bill passes related to PPP. These four things I just talked about relate to both prior loans existence for PPP and the second round. So this is why it's so important, guys, when we talk about this, why we've been trying to tell our clients, unless absolutely necessary, hold your PPP debt forgiveness. Because we're going to talk about a little bit later, and we've already seen it a little bit. Rob's very well versed in it with the HHS funding. There's this double dip. Now we're joking at the office, triple, quadruple dip, that what you put in for PPP forgiveness versus HHS funding, and we're going to talk about a little bit later, employer retention credit, could really impact your ability to maximize each of those items. And so this is just another way, by them expanding what we can look at for PPP debt forgiveness. Remember, only 60% has to go towards payroll. So I might want to use my payroll for some other items, like HHS or employee retention credit, which we'll talk about in a little bit. And I might go after these additional expenses for that other 40% that I need. And so we're really trying to get you to understand that concept. It is sometimes hard to grasp. We too, like you, when this first came out, said payroll is the easiest way. Get my payroll, a summary from my payroll provider, and this is how I'm going to submit. But ultimately, as things keep getting added, you might find that that's not what we want to do. I just bring it open to Marc or Rob to make comment on that.
Lynn, we have a few questions on the previous slide, the taxability here. And I apologize if I butcher these at all. So C Corps for New York State don't have to add back the forgiven PPP. I believe you were talking about just the federal.
So C Corps for New York State are directly linked to the Fed. So assuming that this bill passes, right, then the expectation is the cancellation of debt income for New York State is not taxable. That's clear. Whether this bill passes or not for Fed and New York State C Corps, that's clear. If this bill passes and now we're allowed to take the expenses without any contention, then that also, assuming New York doesn't decouple, would also exist for C Corps. So C Corp follows the Fed. Whatever the Fed does, C Corps will follow for New York State as the law exists today.
So, as the non-tax person, when they decoupled from the CARES Act earlier this year,
it was only for partnerships, trusts, and estates, or what we call, or individuals, excuse me, and what we refer to as our Article 22 taxpayers for New York State. So C Corps are Article 22, so they're still following the Fed.
But they still could potentially add that on to decoupling?
I think that now it's clear that C Corps are getting a different treatment just because they're C Corps than our Article 22 taxpayers. If this bill passes, and we won't get into the mechanics today, but I wouldn't be surprised if New York State addresses that through some additional legislation, but we just don't know.
And how are LLCs being interpreted?
It depends if your LLC is treated, right, as a partnership or if it's treated as a C Corp, right, because you have the right to make those elections for entity classification. But if they're a partnership, then essentially at this point in time for New York State, regardless of what this federal bill says, they've decoupled from the Fed. And so for partnerships, they will indeed, when they get that debt forgiveness, have to include it as income. There's cash and accrual timing issues on that. And then they will have to take the expenses.
But if they had previously elected to be treated as a corporation, then they could fall under the not yet decoupled C Corp guidance?
If they are treated as a C Corp, they fall under Fed guidance.
Okay.
Yeah.
And then one more question. Do you see any potential basis traps for S Corps that do not receive forgiveness until 2021?
Yes. There are basis issues, and please reach out. We'll be happy to talk to you about them. We've had a lot of discussions internally within our tax and SBA practices about this. And again, something we're happy to talk about a little bit more advanced than this discussion.
Okay. And then, yeah, so just so everyone understands, not trying to turn this into a Q&A, but most of the questions that have been asked thus far will be covered later in the presentation. Some of the questions specific to content we've already gone over. I'm trying to address those as we go. One here on do supplies, perishables, essentially mean all food and beverage expenses are approved expenses even after the date of the loan?
I think we would go back and look at that specific definition. We want to keep this broader here. Not to say we're not going to do that for you. And please, if you're a Bonadio client, please reach out to your client service team, and we can get that exact answer for you based on the bill. But we don't want to get into that technical because we still have a lot to cover. So I'm going to.
And I think there's a significant amount of additional guidance that's going to come from the SBA.
Yeah.
Over, after the bill is passed, they have 10 to 17 to 30 days to some 45, depending on which section it is.
Yep. So I think what Mark's referring to is in the bill we've seen, and we give the SBA or whoever they reference additional time to write more regulations. Sometimes it's 14 days, 10 days. It's all throughout. So this is the framework of the bill, but they have specifically said they're giving the authority to write additional guidance to various governmental entities who are involved.
Just to follow up a little bit on the issue that Lynn had mentioned regarding double dipping and just provider relief funds and other issues. And I think that after reading this particular stimulus bill, it seems like there's a lot of expenses that kind of overlap program to program. And certainly with the provider relief funds that healthcare organizations receive, there's a lot of these same type of expenditures, like certainly PPE is usually part of the provider relief fund or eligible. Certainly certain payroll costs are eligible for provider relief funds. And so I think you have to be very careful in terms of how you count whatever expenses that you're including with whichever program. And in particular, I think what we noticed with the PPP changes is there's additional flexibility in terms of the covered period and which weeks you decide to include in with PPP that, again, allows you flexibility that you might want to look at if you're a healthcare organization deciding maybe to use particular weeks of payroll for provider relief funds as opposed to PPP and vice versa.
Yeah, and so I think we've always known about the double dip with the HHS funding, and we're on it, and we still want to be on it. I think this bill will now create a triple dip with how even non-people who receive HHS funding, how they potentially might get into the employer retention credit. So it's really important. If there's one thing you take away from this, it's hopefully that maybe I don't want to just submit my payroll company all my expenses toward PPP debt forgiveness, because that might take you off the block for being able to get to employer retention credits or getting full HHS funding fundability. The one thing I want to point out where we are right now in the slide, because I know we've been talking a lot, we are talking about changes that are currently in the bill that affect not only existing PPP loans, but future PPP loans. Mark is going to get to the second round of PPP funding in just a second, but let's get through. There was two tranches. A tranche in the bill that said we're going to retroactively affect current PPP loans and future loans, and then there was items that were just regarding the second round. So next slide, please. So the other thing I would point out is if you're out there and you said to yourself, well, I returned my PPP loan because I just didn't see how I was going to be able to use it all. Or I got approved for a PPP loan of $2 million, right, I'm just throwing in a number, and I only took $1 million. They have said to you that during this time, if this bill passes, you can go back to your bank and tell them you want those funds, because now they've expanded the expenses you can use them on, right? We talked about the rioting, we talked about supplies, we talked about PPP, and so essentially if you returned it and you say, well, I have all those expenses now, they get your frustration, and so now they're saying you can go back to your bank and say, yeah, I didn't think I really needed the full amount, or I didn't think I needed this loan in the beginning, but now that you've expanded how I can utilize it, I think it works now. Again, remembering 60% still has to be done towards payroll. And so here you see that, as we've told you throughout already, the administrator has 17 days from the time this bill is passed to provide guidance on how you can go back to your bank and request that additional funding. Next slide.
I apologize if anyone's getting feedback from my microphone.
The other big item that you might be aware of is their simplified forgiveness application. So for all my friends on the line who maybe got a PPP loan that were $150,000 or less, you have been very streamlined process for forgiveness. So we here at the firm have been purposely delaying them and applying for forgiveness, hoping that this would come. And if this bill indeed is passed, it will come. So essentially what it says is you get a one-page application, and you're going to sign and submit it to the lender, include a description of the number of employees that the borrower was able to retain because of the loan, the estimated total amount of the loan spent on payroll costs, and then essentially the total loan amount. And you're going to sign that, you're going to give that to your bank, and essentially this was a big lobbying effort by many banks because about at least 80% of the PPP loans out there are $150,000 or less. So I want you to think of the administrative burden if this bill is passed, that just was lifted not only from you people who had $150,000 loans or less, but also lifted from the bank. Next slide. The other point I'd make about this simplified forgiveness application is this applies to both current PPP loans, but also future in the second round if you're $150,000 or less. They did point out that the SBA, again, we talked about these day requirements, must establish what this form will look like, this one-page form, within 24 days of enactment of the bill. And they also said that the borrowers are required to retain relevant records for at least essentially 4 years, but you don't have to submit it to the bank. And essentially, they've limited the review or audits for these loans to only insure against fraudulent activity. So again, it applies to loans that are current in existence or also second covered loans that we're talking about next. So I think at this point, I pass it over to Marc to talk about the next tranche that might come through for second PPP.
All right. So I've seen a lot of questions in the chat about the new PPP loan. To be clear, everything we've talked about now relates to the first PPP loan. Some of the rules, if you have not yet applied for forgiveness, apply to the old loan. If you've already applied for and received forgiveness, it's a moot point in completing the application. We'll get to the impact of EIDL if that's still outstanding on your loan. But so there is a second available PPP loan. Eligible entities are listed here. Generally, it's the same as last time, and with the exception entities listed in 13 CFR 1.10. Again, there's 2 carve-outs that have since been granted on that. And the other additional entities that are not eligible now are any entities that do receive a grant under the Shuttered Venue Operator Grant Program. It's also been extended to, we don't have that on the slide, but 501c6s who were not initially eligible are now eligible in round 2 here. So the rules changed slightly in this second round. The first round, you may remember, it was if the threshold was 500 employees. That threshold has now been reduced to 300 employees. And then if you have multiple locations, it's looked at on a location-by-location basis, assuming, for franchises, it's similar interpretation of the guidance that came out on those. Have or will use your first PPP loan. So that requirement is that, even if you have not applied for forgiveness, if you have incurred enough costs and you fully expect to receive forgiveness, you've used the funding. So that's one of the requirements. And then the last one is this gross receipts test. Gross receipts is not yet defined, but the test will be looking at your first, second, or third quarter of 2020. If you can demonstrate that you've had at least a 25% reduction in gross receipts or more compared to the same quarter in 2019. And then if you're applying after January 1st, which at this point seems to be everyone, you can also use the fourth quarter to compare that to 2020 as well.
So I just want to add here, sometimes we get questions about, well, what can I do to prepare? Obviously, we don't know what the gross receipts test is going to specifically define. We've had client calls to say, is my PPP amount, is my HHS funding included in gross receipts? We're not sure. But at the very least, right, you can start dividing up your quarters, first, second, third, and potentially fourth, and comparing it to the 2019 based on what you would define to include gross receipts. The other point I would make is they have 10 days from when this bill is passed to get us that information of how to calculate gross receipts. So if this bill isn't passed until the 28th, then we're not looking until mid-January that we're going to be able to go to the banks, potentially, to prove that we have a 25% dip in our gross receipts.
I'm seeing a lot of eligibility questions. And I'll tell you first, obviously, it's a legal question that we generally can't answer. We're not lawyers, but without looking at the detail as well of your specific situation. But I'll tell you on a general basis, the eligibility requirements are, if you were eligible the first time, you're potentially still eligible if you didn't trip up the 300 versus 500 employee count. And if you were ineligible the first time, you're likely not eligible this time unless you're a 501c6. That's the only additional carve-out that's been added here. They did make specific mention of, nonprofits and religious organizations that were given that carve-out the first time. They're in again for the second round, again, assuming they don't go over the 300. The affiliation rules and all of that stuff remain the same.
Yeah, and I just want to add, some people are saying, well, if I met test 2 and 3, can I, even though I employ more than 300 employees, can I go after it? And based on this, it would appear to be no. You have to meet that. They are purposely targeting smaller businesses.
Regarding, we do have a question here. What was the deadline? The deadline for the first loan was extended a few times. The ending deadline was August 8th. It's not clear at this point whether, it seems clear that they're not opening up for new loan applicants. Mm-hmm. But if you received a loan, and we'll get into that, you could potentially go back and right-size that loan based on certain qualifying events. Mm-hmm. So the maximum loan amount in this calculated exactly the same as last time, with some exceptions. Again, using your 2019 or your 1-year period before the date of the loan, so potentially 2020. Total payroll, you'll calculate the average monthly payroll and multiply that times 2.5 a month. There is the additional add-on here for entities in the accommodation and food service industry that get to multiply that times 3.5. So 3.5 months worth of payroll costs for those entities. We'll get them, obviously, a larger loan. And the max loan this time is $2 million. Last time it was $10 million. For loans that are not more than $150,000, in addition to the simplified forgiveness application process that Lynn talked about, which applies to the first loan and the second. They've also added this simplified application process to receive the loan. You simply have to make certification attesting that you meet the revenue loss requirements on or before the date that you submit your loan forgiveness application.
And I would say, I know I've read, I think in general, the accommodations and food services industry does not feel like they have been served appropriately in this bill. They feel like it's been short. They're the ones who are hurting the most. But I know people have asked, is there anything specifically for them? I see that specifically for them is they get 3.5 months of their average payroll as opposed to 2.5 months, and that's all that I've really seen called out for them.
And just a reminder, those three tests to be eligible were and, they were not or, so you need to meet all of those requirements. We do have a few questions on the 300 employee count. That based, I believe in the first round it was based on your 2019. If you apply after January 1st, can you use 2020 employee count?
It's a great question. I don't know off the top of my head, to be honest with you, of when they're specifically confirming that employee count. I think that would come out with the future guidance. I don't think that was specifically laid out in the bill, but we can go back and look.
Okay. The loan forgiveness process, again, very, very similar to the first round, with the addition of all the added costs which are eligible. Effectively, if you're running your business and not doing anything extraordinary, costs eligible for forgiveness, those can be used now. And the other item here, the 60/40 payroll test will still be applicable. But given a 24-week period, that has not seemed to be an issue for most.
And the other thing I would just add, we don't have it specifically in the slides, but you should be aware that both for the first and second PPP loans, I should have addressed it earlier, I apologize, they have been clear that it's no longer going to be an 8 or 24-week covered period. If, for example, you feel that your covered period can end on week 12 or week 18, they are giving you the right to end the covered period at that time, which could, again, help you in justification of using your wages towards HHS funding or employer retention credit. So that is a significant benefit, I think. That you can no longer have to be 8 or 24-week exact period for covered period. They're allowing you to have a middle ground, like 12, 16, 18 weeks, which ultimately will help us avoid double dipping.
And you have, sorry, I'm trying to remember. You can select the start of that period as well, right? It's not on the loan origination date?
That I'm not clear on. I still thought that the loan origination date started to kick off, but it was just now that you don't have to choose only 8 or 24 weeks, but that you could get something in between if that works for you. Again, 5,000-page bill, guys, so we're doing our best here to get you the highlights, but there's going to be a lot of more deep dive and guidance that's going to be issued.
There were, the first time around, if your industry code had more than 500, you could still receive a loan. It's not clear at this point if there will be similar exceptions or if those industry codes will receive a 40% haircut as well. There's also, we've received questions on whether or not the alternative size test would apply again. Unclear. There's a lot of guidance that still needs to be issued by the SBA on all this, and at this point, we don't know.
What's interesting about that, and Rob actually found it, in an original bill, they talked about the affiliation rules and directly called it out. In this final bill that went up to the president, it appears that they say, as long as you could have fallen under the PPP grant, or not grant, of the PPP guidance initially, then you can for the second draw, as long as you don't have more than 300 employees. So it's interesting that they gave that really broad piece. So I think they're just referencing everybody back, in my opinion, back to the first PPP guidance of whether or not you're eligible. And I do think it's important to make sure you are eligible, obviously. So that's something that both for either one you should make sure it is met. The other thing I would point out is some people are saying, well, what if I didn't take a first PPP loan? Can I get into the second loan? Absolutely. As long as you meet those requirements, you don't have to draw on a first to get a second. I will say they were very clear that if you get a second, you're only allowed 1 second. You can't go in multiple times to the second PPP funding and try to get multiple loans.
This is the slide that talks about the expanded eligibility. I kind of jumped ahead a little bit on this one. The 501c6s qualify with some exceptions here that are talked about, and most of it relates to lobbying activity. If their primary objective or mission is lobbying, or they receive a significant amount of revenue from lobbying, then they would not be eligible. The next few slides, we're going to talk about EIDL, the old EIDL, the new EIDL. EIDL, you may recall, and this slide also talks about, I see some questions on Section 1112 subsidies that pre-existing 7A, 504, and other microloan recipients received 6 months worth of payments. This talks about that. These are if you recall with EIDL, the first time around, if you applied, they told you within 3 days you would get a $10,000 grant, and then the loan offer would come later. Obviously, it took more than 3 days. There wasn't enough funding. In April 24th, they passed another bill to kind of fully fund EIDL. And then they capped it for certain industries and targeted agriculture. This time around, what they've done is they've said that $10,000, which was supposed to be removed from your PPP forgiveness, is now fully forgivable as well. And to the extent you've already received forgiveness, the SBA will provide guidance to the lenders within some amount of time, 10 or 17 days, on how to remedy that. So you will receive full forgiveness for the $10,000, up to $10,000 EIDL grant that you received, and you will receive forgiveness for any interest that accrued on that or has since been paid. And then the tax treatment for both of these is identical to that of PPP forgiveness, and not includable in income, and the deductions paid are otherwise includable.
Yeah, I think this was huge, honestly, because there was no talk about this prior to this. So everybody, when they ask us, we say they're taxable because we haven't seen anything movement in that. So I just want to be clear, there's 2 EIDL programs we're talking about here. One's the EIDL grant that, as Mark said, was we applied for before PPP fundings. We're supposed to get it from the SBA, capped at $10,000. We actually saw oftentimes they give you $1,000 per employee. And ultimately, that was supposed to get you until you got your PPP funding. And so they said, yes, that we call them emergency EIDLs. That is not taxable. It's not included in your income, and you can still take your expenses. And there's a second type of EIDL that was not considered emergency, an existing loan you might have already had with the SBA. And a lot of people noticed, maybe because they didn't see it in the CARES Act, well, my principal and my interest payments are actually getting paid on this on my behalf. And that was for a 6-month period, and we'll talk about in a little bit, that's actually going to be extended. But that too, that payment by the SBA on your behalf is also going to be not included in your income, and you can deduct those expenses. So both those EIDLs programs gave you benefits, they're giving you beneficial tax treatment. And as I think it's on the next slide, Mark, where we talked about, yeah, be careful. If you've already submitted for your PPP debt forgiveness and you backed out your EIDL, they're saying you didn't have to anymore. They've changed that rule. And so again, they're telling us that the administration will make you whole and essentially make sure that you get that EIDL and it didn't affect your PPP debt forgiveness. But we're waiting for rules from the regulation from the administrator to see how we're going to handle that.
So they've extended the covered period for EIDL grants through the end of 2021. You may recall originally it was 2020. So if this is not just the grant as well as the loan, but the loans were capped at $150,000. Most should have enough covered expenses to cover the They also added some flexibility for the SBA to verify applicants. That's written here. And they extended the time for the SBA to approve and disperse emergency EIDL grants from 3 to 21 days. So we've had some questions. Is EIDL open again? Can we get more EIDL? The answer is on a limited basis. If you're in a designated low-income area and you did not receive an EIDL grant, you are now eligible for an EIDL grant. If you're in a low-income designated area and you received an EIDL grant of less than $10,000, you can now upsize that to the full $10,000. And just a refresher on how that worked. Initially, they said everyone would get the $10,000. Then they determined to give $1,000 per employee. So if you were a single member LLC, you got $1,000 at most. So if you're in a designated low-income area, then you can now upsize that to $10,000, and there will be guidance provided.
So, Mark, one question that I'm thinking about that many of our clients might have is originally when they applied for PPP and they had PPP loan financing, and they didn't necessarily need the EIDL loan, but certainly could have qualified. And since they were going to get the $10,000 grant, and it was just going to offset forgiveness, it just didn't make sense for them to pursue the EIDL loan. Does it make sense to do that now?
Yeah.
If they're in a low-income area, if they want the grant, the loan,
But the emergency EIDL.
They can still obtain.
The emergency EIDL, if you didn't go after the emergency EIDL, I think, based on my understanding, and Rob's saying, I see Mark saying, let's check. My understanding is, and we'll check, but my understanding is if originally I didn't go after it because I knew it was an awesome IPPP and I just wasn't going to bother, I think you can still go after the emergency EIDL now if this bill gets passed. So we'll have to.
Yeah, that's fair. I know you should be able to still apply for a loan. I think they've funded that process more. I'm not sure about the emergency grants, because now they put in the targeted EIDL, which is on those focused demographic areas, but I don't know if you can get the grant still.
Yeah, we'll look at it, but I think the emergency EIDL changes, they reference back to the original CARES bill, which didn't put that restriction on low-income housing. So I still think that could be a possibility, but something to definitely watch us through the next
Right.
week. So.
And
makes
then
sense.
On the one we talked about here with the the businesses that receive 6 months of payments, that's now extended for another 3 months. So the section 1112 of the CARES Act, and they're capping that at $9,000 per borrower per month now. And then the interesting part is, if you're a new borrower between February 1st and September 30th of this upcoming year, you will also receive 6 months of payments on the newly approved loans. So it's more incentive to go after those low-interest loans already. Now you'll receive 6 months paid by the SBA.
And just so we're clear, guys, if you do have an SBA loan, this is a huge cash impact, right? That they're going to, if you've been getting more than $9,000, you got to push it in. But B, it's going to be extended essentially starting in February for another 3 months. So, again, I think everybody is feeling we got to get through January, February, March, and April hopefully be vaccinated and things will start, more of the population will be vaccinated and things will start getting back to semi-normal. And so they're trying to cover you for that period. So make sure to include that in your forecasting. Okay, so we're going to move on to the employee retention credit. And all of you on this line are probably, if you didn't take a PPP, if you did take a PPP loan, you're probably like, what is an employee retention credit? And the reason you are saying that is because under the original CARES Act, they said that the employee retention credit was only available to people who didn't take the PPP. Well, lo and behold, not surprising, we have seen that they have retracted that statement and essentially have said, no, even if you take the PPP, you might also be able to get the employee retention credit, provided that whatever payroll you put towards PPP debt forgiveness is not the same payroll that you put towards the employer retention credit. So hopefully your ears have perked. We've talked a lot about this firm-wide, especially in our federal tax update, that essentially this is a huge benefit that's going to open up, but we have to do it right. So the first thing I would point out is up until December 31st, 2020, so a couple days from now, the employer retention credit is as follows, because essentially what this bill did is it opened up your ability as a PPP lender to get it for 2020 under this rule, but then also to get it under 2021 under a modified rule. So again, similar to what we saw in PPP retroactive law and moving forward law. So it's same with employer retention credit. So even if you got a PPP loan, if you, for a calendar quarter, you are allowed to look at 50% of qualified wages if you are considered an eligible employer, up to a maximum credit of $10,000 employee for the year. And I should say that's maximum wages. So essentially, I want you to think about this. If we can get you into the eligible employer bucket for 2020, then essentially you can look at the wages of your employees up to $10,000, and I want you to think they have a $5,000 price tag on their head, right? So up to $5,000, 10,000 times 50%, you could get a credit that would offset the payroll taxes you're paying to the U.S. federal government. So what does it mean to be an eligible employer in 2020? I think if we go to the next slide. So here we're gonna walk through this a little bit. You're gonna see the modified law, and then you're gonna see the old law in parentheses. So you'll see this says that it's effective as January 1st. But before we get into January 1st, let's say what was it currently. So we talked a little bit about this. One is you're allowed to look at the qualified wages of your employees up to $10,000 for the year. It started in March to the end of December 31st, and you're allowed essentially to look at 50% of those. So you're still sitting there saying, great, Len, I see it, $5,000 on an employee head, but how do I get in there for 2020? So 2020, the two ways you can get in there is, and it's an OR test. One, you were fully or partially shut down due to COVID. So I want you to think about your restaurants, your retail stores, maybe your construction. That's one way to get in this. The second way to get in this is essentially to say you had significant decline in gross receipts. Is that on the next slide here, Mark, so they can walk with me? Yep. So again, the first way to say you're an eligible employer for 2020 is to say you had a full or partial shutdown during a quarter. The next way is an OR test, is to say you had a significant decline in gross receipts. Until the end of 2020, a significant decline in gross receipts is a 50% decline when comparing quarters. Fourth 2020 quarter to fourth quarter 2019, third quarter of 2020 to third quarter of 2019, etc. However, as of January 1st, 2021, we're going to see that dip to say, well, now you are deemed to have a significant decline in gross receipts in January, February, and March of 2021. I don't need a 50% anymore. I only need a 20%. So essentially, I'm going to take you back just one second. In the current taxable year, if from March to December 31st, 2020, you were either, right, an eligible employer by either having a full or partial shutdown, or you had a significant decline in gross receipts of at least 50% when comparing quarter to quarter. Even if you have a PPP loan, you can now look at eligible wages of your employees, and up to $10,000 for the 2020 taxable year, you can take a 50% credit. So again, a $5,000 credit potentially on each employee. Can you go to the next slide?
And Lynn, this similar to PPP, this is just for W-2 wages, right? Now, can you use 1099?
Oh, no, yeah. So we're talking about qualified wages. So that's a great question. You're saying, well, what are qualified wages? So again, for 2020, am I an eligible employer? Did I have a full or partial shutdown? Did I have significant gross receipts of 50% or more for any quarter? If either of those answers are yes, now I'm coming to what are my eligible wages? And your eligible wages, if you have, again, this is for 2020, 100 or fewer employees, you're allowed to look at any of the W-2 wages that you paid your employees at all, whether they provided you a service or not. So, for example, let's say that I had a company where I paid some people just to stay at home, but they couldn't be functional from home, but then I also you're under 100 employees for 2020, you get to look at all of those wages. If, on the other hand, though, you were more than 100 full-time employees, then essentially you're only allowed to look at the wages that you paid someone for not performing the service. Again, this is as of December 31st, 2020. If you flip to the next slide. We probably should have started with this slide. It makes it much simpler. I apologize. But essentially, everything I talked to you about so far is effective from March 12th to December 31st of 2020. So you might say, okay, Lynn, I didn't have a 50% gross receipts reduction. I did take out PPP. I don't think I had a full or partial shutdown in the 2020 taxable year. And I would say, okay, well then maybe you're not going to get it for 2020. But then I would say, but the rules change as of January 1st, 2021. So I just want to make that clear. For those of you who are sitting and say, yes, Lynn, I received a PPP loan. I absolutely was partially or fully shut down, or I absolutely had a decline in gross receipts of 50%. I'm telling you now, if this bill passes, you can get this credit for wages you pay your employees for the 2020 taxable year. The amount of wages you're allowed to include will depend on how many employees you have, but the credit is viable for you. Prior to this, the credit was not viable because you had a PPP loan. So then let's talk about, okay, Lynn's going to help me, Bonadio's going to help me get 2020 figured out. Now, what am I looking forward to in 2021? Again, if you have a PPP loan, first or second round, you're still in it, okay? Now what they've done to say you're an eligible employer, full or partial shutdown, still valid. But now a significant decline in gross receipts has dropped, and it's dropped to 20%. So essentially now, when comparing my first quarter of 2020, right, to my first quarter, my first quarter of 2021 to my first quarter of 2019, if I saw a 20% or greater drop, I'm in. Okay, so now I don't have to show a 50% gross receipts. Now it's only 20%. Well, that's a good answer, right, because it might get more of us in. So that's one. The second thing that's really important is now that, remember, for all of 2020, you had a $10,000 amount that you could look at for wages times 50%, so maximum $5,000 credit. In 2021, they're allowing this for the first 2 quarters, and they're essentially saying you're allowed a $10,000 wage amount for each quarter, and the credit percentage for employees bumps to 70%. So now, for quarter 1 of 2021, if I'm available, now my employees are walking around with a $7,000 credit on their head for quarter 1, and then another $7,000 credit for quarter 2 if I can get in there. So for 2021, I could look at a $14,000 credit, whereas for 2020, the max I could get at was 5. Okay? And in 2021, it's much easier for me, not much easier, but it's easier for me to fall under the employee retention credit rules. They drop that gross receipts test, right? And then the last thing I would point out that is significant if you're a large employer, they've raised the large employer definition from 100 to 500, which means if you have 500 or less employees and you meet the mark in the first quarter of 21 or second quarter of 21, you can look at all the wages you pay, regardless if they perform services for you or not. If you have more than 500 employees and you meet the eligible employer, you're still in the running. But essentially, the wages you're allowed to look at only are wages you're paying someone who can't provide you services. I'm going to end it with this example because I know that can be confusing. Think of a large employer. Think of a trucking agency, right? All your trucks previously went to restaurants and they went to Wegmans, okay? If I'm under 100 in 2020 or under 500 in 2021, then essentially I'm allowed to look at the wages I paid both. Both the ones that went to the restaurants that no longer are going anymore, I'm paying them, but the wages I'm still paying my employees to truck to the grocery stores. If I'm over 100 employees in 2020 or 500 employees in 2021, I'm only allowed to look at the wages I'm paying for the truckers who aren't going to the restaurants, but I'm still paying them. This is, I know, convoluted. It's something different. You probably didn't have your eyes on if you had PPP. This is significant. Okay, you need to be talking, these credits can be large. Think about that, $14,000 a person potentially. If you have 10 people, right, you're looking at $140,000. I mean, that's a lot of money. So it's very important that you're reaching out and learning more about this credit as we move forward.
A lot of questions on this one, Lynn. some people might have still been thinking PPP and they weren't listening when we went over this.
Okay.
Who's eligible? Is it generally the same as PPP?
Okay, so the eligibility requirements, you're going to assess it quarter by quarter. So in
Types of business, though.
Oh, types of business.
Sorry.
It's a great question. I just think that you have to be an employer, right? I've worked with not-for-profits on the ERC. I've worked with hospitals on the ERC. I've worked with educational institutions. I've worked with businesses. So it's not I think it's mainly, are you an employer of an employee who meets these requirements? In addition, I would point out that the full or partial, sometimes people get confused and think it's an and test, it's an or test. In quarter 1, 2, it's really quarter 2, 3, or 4 in 2020, were you fully or partially suspended? If you were, for that particular quarter, you're in. You got to prove that you meet that in each quarter to assess the wages for each quarter. It's not like if I said I was fully or partially suspended in quarter 2, I could count the wages from 2, 3, and 4. I can only look at 2, and then I have to reassess in quarter 3. And then the opposite of that is you have a significant decline in gross receipts.
So you had PPP in 2020. Can you go back and amend quarters in 2020 to claim the employee retention credit if you have enough eligible wages?
Yes, but here's the double dip, right? So here's what we're saying to you. What they say is if you put that payroll on your PPP debt forgiveness application, you can't take it for the employee retention credit. So that's why we have to be strategic, right? So let's just pretend and say quarter 3, Lynn, is when I saw that, when I got partially or fully shut down, or when I saw that significant decline in gross receipts. I say, okay, if that's the case, we want to use all those wages or the most wages to apply towards this employee retention credit. So when I apply for my PPP debt forgiveness, I'm not going to include the wages from that point. Remember, I only need 60% of my PPP debt forgiveness to be wages. I'm going to scour my utilities. I'm going to scour my mortgage interest. I'm going to scour my rent. I'm going to scour these new 4 categories that were just brought up. PPP protective equipment, property damage due to rioting, all of those things to get to my PPP. And then I'm going to hold that quarter, which I said I had a full or partial shutdown, to apply to my employee retention credit. So it's really important. And I know if there's an overriding reason, talk to your advisor, get your debt forgiveness in. But my point is, stop. Do not put your debt forgiveness application in at this point. There's more things to vet between HHS and employer retention credit to maximize what you're going to get from these bills.
The new 500 employee threshold for small, large here, is that retroactive for all of the 2020 quarters? Just go forward.
Just go forward. So everything, it's a great question, and I had to go into that and take some time on that. The increase to 70%, the increase to $10,000 per quarter instead of year, and the increase from 100 to 500 employees is for 2021 forward. You cannot retroactively apply those 3 rules to 2020.
For employees you're paying that are not working, what about if they're working 20 hours a week and you're paying them 40? Can you take the difference?
Absolutely. Also, for furloughed employees, if you're paying their health insurance, that would still count towards this credit.
And yes, as is the case with everything we're saying today, the law needs to be passed before any of this applies.
Yeah.
And then, so the mechanism, if you want to go back and claim this for 2020, is you amend your 941s, right? Obviously, you need to determine your eligibility, you need to calculate the cost, you need to look at the interplay with PPP. Then you amend the 941 and offset against your employer and employee portion of the payroll tax. What if there's an excess? How does that carry forward? And is it refundable?
Yep, so if there's an excess, there is a way, there is a mechanism to get that refundable. So it's a different form, but you can say, okay, I've wiped out my liability, you still owe me more. You can either wait to apply it to your next payroll report, or you can ask for that funding to be given back. I will tell you this, regardless of this bill, we have been doing this for other people who couldn't receive PPP funding. We have found that payroll companies are somewhat not as pressed, and probably will become more pressed with this bill, to file that amended. We had one person who was looking at over $1 million, and they said, well, we can't file your amended payroll until 6 months from now. Well, that's not the point, right? So I think it's going to be an interplay between your accounting teams, your advisors, your accounting advisors, and your payroll companies to get those out the door. And it's usually something, I mean, I can say as a Bonadio group, we do some, but I mean, that's not our, for lack of a better word, bread and butter. But it seems, because of the increased importance of getting that cash back in the pocket, you know, if you need it before 6 months, reach out to your advisors and see how they can help you push that along.
Yeah, I would say with most of the payroll companies, if you're not doing amended, it's generally as easy as, you know, you provide the calculations and the amount, and it's kind of flip of a switch. If you're going back and amending, that's where it can drag out.
Yeah.
If you don't have a payroll company and you need to do a lot of these calcs internally, that process obviously can be a little more cumbersome as well.
Yeah, I think what we found is that the payroll companies don't feel as adequate of making the calc. If you provide, like, we've worked with people to make the calc and then it's pushed into the payroll report, but I haven't seen the payroll company feel like they could help advise on this calc. Okay.
Yeah, and this is a credit. It's not a deferral of pay. That's a whole separate animal. And to be clear, again, these amounts on here, the $10,000 per employee, it's not, you know, it's not like PPP where your employees are capped at 100. Each employee, as long as they're paid $10,000, is eligible toward that. You are eligible as an employee for that $10,000 wages at 50%. So each employee is worth $5,000. That's for 2020. And then for each quarter in 2021, they're worth 70% of that $10,000 per quarter. So if an employee's gross wages are $40,000 for the year, and you're paying them $10,000 on a pro rata basis, each employee that's over 40 would be worth $7,000 credit per quarter.
It is not a grant. It is a tax credit. You will never have to pay it back. You do need support, you know, to justify what you've done, which obviously we do in everything we do. But this is a dollar per dollar reduction on your payroll taxes if you qualify.
Lynn, one other question on this. There was a way to claim a quick refund, as I recall, on this. I think you had to meet certain thresholds to do that. Otherwise, you do it on the 941 against your payroll tax.
Yeah, I think the quick refund is, again, if you're going to go above and beyond your payroll taxes, and you don't want to, so the quick refund is you don't want to wait till the next quarter to wait for the credit. You want them to actually pay you cash.
And one other thing, sorry, before I said the payroll tax, but as I recall, this on the 941 offsets your federal income tax withholdings as well. Right? So there shouldn't be much of a carryover.
So it affects your employer payroll taxes, right? Not your employee federal.
No, I believe you can offset your federal income tax withholding, your employer payroll tax.
Right, but it doesn't. I guess I would clarify. It doesn't reduce your employees.
No, the employee withholding stay the same.
Yeah.
You as the employer generally hold them, or your payroll company holds them until they're remitted to the federal government. You can offset all those amounts.
Yeah, agreed. Okay, I want to give time to Rob, so reach out, let's talk about this. This is huge, guys. I can just tell you a lot of people don't realize, because it wasn't on anybody's radar, we got PPP, and this is going to be important over the next 3 to 6 months to get your hands
around. And to be clear, real quick, before we go to Rob, on the PPP thing, up until November 18th, generally, the guidance was, especially for smaller loans, let's just wait and see, no hurry to apply, especially if there was a good tax answer for waiting. Mm-hmm. On November 18th, the IRS and Treasury issued the rep proc that said, doesn't matter when you apply, it's a taxable event in 2020. So then it was, okay, let's just apply and get it over with. There was really a rush to apply. Mm-hmm. And until this passed on 2 days ago.
Well, that passed until
3 days ago, and then we saw the wording. Yeah. It wasn't, this employee retention credit and the interplay with PPP was unknown.
Right.
So it may sound like we're telling you something different every few weeks, And that's because we are.
Because the law is developing.
Because the law is changing, the guidance is changing, and the potential opportunity is changing. So it's those payroll amounts that you're using towards PPP that you would potentially want to limit to that 60% threshold.
Yeah, and that 500 employee threshold is important. I've seen a lot of clients that are disappointed with the 300 employee threshold with PPP in the second draw, and now they're looking for the employee retention credit because they're below 500 employees, and now this is something they might be able to take advantage of.
Agreed. And I think the employee retention credit is going to be a big cash impact if you use it right, guys. So, okay, let's swing it over to Rob. He has some very...
Yeah, I don't think I was...
Oh, sorry. And this is just, it's not immaterial. I'm just going to go through this quickly. For any of you who are 500 or below, I think you already know that you have an FFCRA, Families First Corona Response Act credit. And the credit essentially was for paid sick or paid family leave. And essentially, because you were mandated that you have to pay these people who take the sick or family leave, they provided you with a credit. If you go to the next slide, you'll see that what was significant about the FFCRA, go to the next slide, was what they allowed you to say was a sick leave or medical leave opportunity. And so it wasn't just that I had COVID or someone in my house had COVID, but they were very, they expanded it to say if you had a child of an employee whose child care has been closed or provider has been closed and they were unable to work, right, because they had to be with their child, which I know we all have had potentially to be home with our children and may, again, have to. So that was qualified sick leave, 10 days. Medical leave, they expanded, though, to include also having to stay home with your child, which was 10 weeks. So the only thing I'm pointing out about all this is if you're under 500 and you've been paying these, make sure you get the credit. This bill extends this credit. It was supposed to end on December 31st. It is now extended until March 31st of 2021. If you go to the next slide, Mark, this is also a significant credit. So if you have been paying people who haven't been working because they were qualified sick leave or family leave, you want to make sure you're picking this up. Again, it's something you can amend for on your payroll return, but it's maximum of $511 per day or up to $5,110 for qualified sick leave. Again, if they have to stay home to take care of their children, that's included. And then the 10-week qualified family leave wages, the maximum would be $10,200 times 10 weeks. So again, that was supposed to end on December 31st. If this bill is signed by the president, it would get extended to March 31st. The nice thing about this, I would point out, is now we're talking about the quadruple dip because you can use your payroll towards FFCRA payroll credit. You have to be an employer less than 500. Then you can use it towards employee retention credit. You have to have a full or partial shutdown based on the quarter or a significant decline in gross receipts. You can use your payroll towards HHS. You can use your payroll for PPP. So as you see these bills coming through, things start to get more complicated.
Okay, so Lynn has a break and Mark has a break. Hi, I'm Rob Nasso, and I'm going to talk about just a number of other programs that were included in with the COVID relief bill. And this one is near and dear to my heart. I actually go to see a lot of shows, live theater, concerts. I go to see, live music. In fact, I remember on March 13th, I was actually eating at a restaurant with my wife. Her birthday was March 8th. We were supposed to see a show that night, and of course, that's right when the pandemic hit, it shut down. We also had concert tickets at the end of the month, at the end of March. We had a weekend escape as part of her birthday party or celebration. That got extended to October of 2020, and then recently, that particular concert that we were supposed to go to has been rescheduled for October of 2021, and so needless to say, my wife is just not very happy about her birthday present because she hasn't gotten one yet, although I did make a nice contribution to Jiva Theater for those tickets for the original live show that we were supposed to see. But these grants for shuttered venue operators are just huge. I mean, those organizations were pretty much shut down. Many of them did take advantage of PPP loans, but obviously that only helped them for a certain period of time. Most of them, used the PPP proceeds paid their employees for 8 to 12 weeks, whatever it was, and then essentially had to shut down. And so it's one thing to not be able to pay their employees, but it was just a huge, huge hit on most of those organizations. Many of these are not-for-profit organizations, heavily subsidized by grants and other things, and so they've been decimated by this. So this is a fantastic opportunity. Obviously, it covers theater, live theater. Museums are also included with this. Motion picture operators. A lot of different kind of organizations that are included in the shuttered venue operators program. Couple criteria: they needed to be operational on February 29th of 2020, and then the second provision, which is very similar to the PPP Second Draw, they need to show that they had a 25% reduction in gross earned revenue during the quarters, any quarter within 2020 compared to 2019. Another kind of hurdle that I see many of them are going to struggle with is that at the date they receive the grant, they either need to be open or they need to intend to be open. And for a lot of organizations, they're simply not allowed to be open. Certainly here in New York, there's a lot of restrictions on that in terms of gatherings of more than 50 people. It's just not safe for a lot of these organizations to be open. So, I think a lot of that definition of what that means in terms of intending to be open, is we don't really have right now, but that's something to definitely pay attention to. I think the fourth criteria also you should take a very, very close look at. It's about meeting specific characteristics as required by law. And if you look at the particular law, there's very specific definitions of each of these venues and requirements and things that you need to do in order to qualify. And I think this is just to kind of eliminate, those organizations that really aren't live theater operator. For example, if you and your buddies put on skits for all your friends and you don't charge anything, you're not going to qualify as a performing arts theater. And so that's something to kind of take a look at. There's $15 billion that have been appropriated for this, and $2 billion of it has been set aside for smaller organizations of less than 50 FTEs. And so, if that money doesn't get used up, that would still go into the general pot. So, how's the grant calculated? This is just a great opportunity. Basically, the grant is equal to 45% of your gross earned revenue during 2019, not to exceed $10 million. So obviously, if you had $20 million of gross earned revenue in 19, you would be eligible for a $9 million grant. So that is huge. I think the thing to pay some attention to, and again, I think a lot of these definitions haven't been clarified yet, is what gross earned revenue is. And I've looked at a couple of our clients that are not-for-profit organizations. They're heavily subsidized by either the city, the county, other organizations. They receive what I would consider to be non-earned revenue. That would be excluded. The one I looked at was about $10 million of revenue, and I'd say about 60% of it was actually gross earned revenue. The rest of it was all grants and other things that they've received from either the city or other organizations. So that's something, pay attention to that calculation. Don't think you're just going to get 45% of the total amount. The other thing I want to mention is there's also a supplemental grant as part of this program where you're eligible to receive 50% of your initial award effective April 1st of 2021. Again, assuming the funds hold up, there's going to be, a second round. You get your first, hopefully, $10 million. Then you'd be eligible for another $5 million, effective April 1st of 2021. So the timing in terms of using the funds is you may use these funds anytime from March 1st of 2020 through the end of 2021. And so obviously that's a long period of time. That's a 21-month period. And as Lynn mentioned before, just be careful with double dipping. You can't really count, expenses that maybe you included in your PPP application that was, after obviously March 1st of 2020. So pay attention to that.
And Rob, I would just add, this is more significant than PPP funding. So there's an option to do a second round of PPP for these people, or to do a shutter vendor operator grant. And I think if they can qualify under the grant, unless you would say otherwise, this is where they want.
Yeah, this seems like a very, very generous program, that can, obviously be huge for, these types of operators. The allowable expenses are very similar to PPP, covered mortgage, rent, utilities, covered worker protection, expenditure, payroll costs, very, very similar to PPP. And obviously the prohibited expenses are fairly straightforward. You can't use the funds for purchasing real estate or, lobbying or contributions to political parties.
Brad, one question. There did seem to be some language in there about more scrutiny on these, and I think the administrator has 45 days to report to Congress on their plan to, I think, audit or assess the need of the recipients here. Any idea how that'll shake out, or is that?
I don't know. I've read those provisions that are included within the stimulus bill, but I think it's fairly vague. There is some. I think they feel that this particular program, is susceptible to fraud and abuse, and I think that's one of the reasons they added all those characteristics that were part of it. And again, there's not a lot of reporting other than verifying that your, gross earned revenues in 2019 were at least the 10 million, or at least, getting your grant was 45% of that gross earned revenue. But obviously you do need to spend the money on allowable expenses. Okay, one of the things that we received a lot of complaints, or a lot of people complained about the CARES Act in particular, was just the way the money was distributed. A lot of it was in haste. Sometimes people felt that money went to organizations that didn't necessarily deserve it. I think this particular program, was very well thought out. It's being distributed on a priority basis. And so the way the program is going to work is an administrator is going to be appointed that's going to oversee all of the grant applications. And so the first priority is going to be this initial 14-day period where the expectation is this is going to happen shortly after the bill is approved. So I would expect that this is probably going to happen, assuming the bill gets approved in the next couple days. This 14-day period is going to start, and the grant application process is going to start. But the first priority is within the first 14 days is the money would go to organizations that experienced at least a 90% loss in revenue from the period April 1st of 2020 compared to that same period in 2019. And so these are businesses that were organizations that were severely impacted by the pandemic because they only had 10% of the revenue. After that initial 14-day period starts the next second priority, which is the next 14 days. And this period covers those organizations or includes those organizations that suffered at least a 70% revenue loss during that period. And then after the end of the 28-day period where you've gone through those organizations, the program opens up to all the other eligible applicants that are part of this grant. I'd say the one thing that's unknown, that I haven't seen any information on, that you should be aware of, is the timing of all this. I think we've all had experiences with the CARES Act where the money dried up, where organizations wanted to apply for PPP or EIDL loans, and there was no money left over. I think my recommendation would be to get your application in. I'm not sure exactly how it's going to work with the priorities. Whether you'll be able to apply on day one, whether you had the 90% or the 70% just to get your application in, and whether it's going to be first come, first serve, or whether they're going to actually, prioritize those remaining applications. But I think, if anything, what I would suggest is get your application in as soon as they start accepting grants.
Who is administering this program?
It's an administrator. I'm trying to think of the title. Because I'm not sure if it was part of the SBA. I'd have to go back. I know it was, I don't recall. Yeah. So, it could be an administrator of, that's part of the SBA is what I would think.
Yeah.
Okay.
Yeah,
one of the reasons this came up to everyone is that, you've probably heard 50% of museums across the United States shut down during the pandemic. So this is really, I think, a target to try to keep that alive.
Yeah. certainly a tremendous opportunity for those organizations. So some of the other things that just to be aware of that were part of the COVID relief bill, additional $8.75 billion that was part of the CDC, to distribute, administer, monitor, track the coronavirus vaccinations, just to ensure that they're broadly distributed and there's access and vaccine coverage. $4.5 billion of that, goes to state, local, territorial public health departments, and $300 million to underserved populations, which is particularly important because many of these populations were severely impacted by the pandemic. Another piece of it was $10 billion goes to children and families, and I think any families that utilize child care or daycare, they can, those particular industries were hard hit as well. Another $250 million goes to the Head Start program. And then education has been pretty much left out of a lot of the CARES Act funding so far, and so this was good to see this. Anyone that has children or kids that are in school, you can see there was tremendous disruption in those activities and processes. And they've had to obviously incur additional expenses in order to create safe environments and create opportunities for the children to be educated. $54 billion of that goes to elementary and secondary school programs, and a lot of that has to do with facility improvements. And there's been a lot of expenditures that I've noticed that included heating, ventilating, and air conditioning systems, not just for this program, but a lot of our healthcare organizations have done similar things. And then $4.1 billion for Governor's Emergency Education Relief Fund, which includes some non-public schools. And lastly, about $23 billion is going to higher ed, which has been extremely impacted by the pandemic. Same thing, drops in enrollment, a lot of shutdowns, a lot of the schools closed early and had huge enrollment declines. $1.7 billion goes to kind of minority colleges and universities, and $113 million goes to institutions with unmet need. Okay, you can see the Grinch, and basically the Grinch stole the provider relief funds. And I'm saying this because I'm a healthcare partner, primarily work in the healthcare industry, and essentially what happened was this bill about a week or so ago had $35 billion, and you can see it all gift wrapped there, all ready to go to healthcare organizations that really need it. And at the last minute, all of a sudden, that $35 billion turned into a $3 billion lump of coal, thanks to the Grinch. And so, this was kind of very disappointing that there weren't additional provider relief funds. The CARES Act that was passed back in March had $175 billion that went to the provider relief funds for healthcare organizations. So I know many of you that are not healthcare don't feel too sorry about them, but healthcare organizations, many of them are still be able to take advantage of some of the other programs that are part of this, including the PPP Second Draw and the employee retention credit. What was included in the $3 billion was a one-time increase in the Medicare physician fee schedule of 3.75%. And that supports not only physicians, but there's a lot of other services that are billed under that physician fee schedule or based on that. So I think that was definitely something that's going to help healthcare organizations. In addition, they delayed the 3% or the 2% Medicare sequestration adjustment that's across-the-board cut to all healthcare providers for their Medicare revenue, and that's been in effect since the pandemic. This extended it through the end of March. There was also some phase-out of cuts that were supposed to happen to healthcare providers, so all of that kind of totals about $3 billion. Okay, lastly, a couple changes and extensions with the pandemic unemployment assistance. Basically, that program is there for individuals that didn't normally qualify for unemployment insurance benefits, people like independent contractors, gig workers, employees that didn't have sufficient work histories. And I think, what many of our clients, our businesses have said, that most states have been pretty generous with approving unemployment benefits, and so normally you don't need a lot of the requirements that you have in the past, but the good thing is this did reinstate the program, extended it from 39 weeks to 50 weeks, which should carry it through April 5th of 2021. The second item is 50% credit for unemployment benefits or costs that government entities and not-for-profit organizations have to pay. Many of our not-for-profits have struggled with this credit. This is an extension of what was already in play, and many of them had difficulty getting this credit. But again, they should still be eligible for it. This is a continuation of that credit. It's a huge help for our not-for-profits. And then lastly, the extension of the supplemental benefit of unemployment insurance. And I'm very grateful for this because I have a daughter that receives this supplemental payment. And so every dollar that she gets from unemployment is one less dollar that I have to subsidize her for. So I'm grateful for this program. But as you recall, this was the original $600 benefit that was a supplement back, after the pandemic was first, after the CARES Act was passed. That $600 benefit went away for a period of time. It was replaced by a $300 a week program for 6 weeks, and now this benefit is back to $300 a week starting on December 26th and continuing through March 14th of 2021. So it's really helpful for certainly for those individuals that are unemployed.
Yeah, I'm not going to go through all these for everyone. They'll be in the slide deck that's distributed, but essentially, there were some other changes, many of them just extending what's already out there in existence for an above-the-line deduction for charitable contributions, not only in 2020, but they extended it to 2021. You might have heard this year, there's usually a limitation on your cash contributions of 50%. They've upped it to 100% for individuals, and it's extended. Temporary allowance to allow all your business meals to be deducted instead of 50%, and that's for business meals incurred after December 31st, 2020. So that kind of helps the retail or the restaurant industry. Hopefully, will encourage businesses to get out there in 2021. And then, if you're like me with children, you probably were frustrated that you maybe didn't use all your dependent care flex spending arrangement in 2020, and essentially that means you lost it. They put a specific bill in that said they won't fail to treat those plans as cafeteria plans merely because you're allowing your employees to roll 2020 non-used funds to 2021. So that is something that's important. Then the rest of it has to do with extenders. They're broken out between first or 1 year extenders, 2 years extenders, 5 years extenders, and they really essentially have changed the lobbying effort. Normally we extenders just 1 year. Now we see some in play for 5 years, including WASI, which I know is important to a fair amount of our clients. In addition, Biden's bill is looking to include people who were laid off for a certain time during COVID that come into the workforce again, that the employer would also be able to get to WASI. So I think that's why we saw that extended for 5 years, so that they could play with that during the Biden administration. But there's a lot of other items in here I'd encourage you to read through, especially if you were looking to get involved in understanding the extenders. Overall, I just want to say thank you for your time today. We hope that this was useful. I want to reiterate this bill has not been signed by the President on December 23rd. The President has not signed this bill. This bill is not law yet. It's something that we'll be looking at. Things that you can definitely be engaging in is understanding obviously what Rob just talked about, and are you a person who can maybe receive a significant grant? Second, PPP funding, looking and retrospectively looking at your employee retention credit, and a variety of other things that were touched upon today. But there are things, we know that some people are saying, I'm just going to wait for the bill to pass. We totally respect that and appreciate that. But there are other people saying, I want to get my ducks in a row. You can use this discussion and this PowerPoint to help you try to get those ducks in a row, still realizing it's not a final bill, wasn't signed by the President yet, and still realizing that a ton of regulation is expected to come from governmental agencies, and then after the bill is passed, in a 2 to 45-day period. Anything else to add, Rob and Mark?
going to add some questions, if that's okay.
Sure. We'll allow people to drop off if you choose to do so. We'll answer some questions.
Yeah, we still have about 75% of our initial attendees here and declining. But just to get to some of the questions that we had along the way, will individual payments be a direct deposit, prepaid cards, checks, or a mix like last time? I don't know that they specified that. I would assume it will be similar to last time. Maybe they won't do as many prepaid cards because there were some issues there. Is there a definition of full or partial shutdown for use of the employee retention credit? I believe it has to be subject to a government order. There are some different interpretations of what a government order means: state, local, national, guidance of CDC, HHS, or OSHA. So
Mark and I, and I'm sure Rob, but Mark and I in particular have answered a lot of questions on that, and it's a gray area. So it's something that has to be vetted, I think, with advisors.
If you're an essential employer and you plan to pursue this, I would like to make sure you at least have the legal opinion.
True.
Loans over $2 million. Received a couple questions on loans over $2 million, initial round of PPP, and the Form 3509 questionnaire. To date, in the PPP forgiveness application process, I'd say generally we're seeing for loans under $2 million a 3 to 5 week window for approval through the SBA. For loans over $2 million, I personally have maybe dealt with a dozen that I've advised. I have not yet seen approval. I've seen them go to the SBA. Just a reminder, the bank has 60 days to review and the SBA has 90 days. Some of the banks I've seen are using most or at least half of that 60 days on their end, making sure they're putting their best foot forward and truly vetting the loan. And then it's going off to the SBA, and I would venture to guess they'll use close to that 90 days that they have as well. The Form 3509 questionnaire, just a reminder, I know it caused a lot of stir and panic. The SBA said at the onset these audits over $2 million and some others maybe down the line, they would include the initial eligibility and the initial loan amount, the eventual forgiveness and the calculation of that, and they would also audit your certification, your good faith certification of need. So how are they going to do that? This questionnaire seems to be the answer to how they were going to audit that. I have not seen any pushback yet to date. I've seen some that clearly needed it based on the way they answered the questionnaire, and some that you could argue didn't. But until we start seeing some responses to those, it's a giant unknown still. The
only thing I'd say about the questionnaire is please be cautious of how you're answering it. I'm not telling you, obviously be truthful, but there is things that, maybe supplemental attachments to further explain items or give additional feedback. We've helped a fair number of clients through that. The other thing I would say is there was a lot of language in this bill about setting up audit criteria and review criteria and who they'll report to, and essentially a lot of it reporting to the Senate Finance Committee and the House of Representatives, I'm blanking on it, Senate Finance Committee and the House of Representatives Ways and Means Committee. Thank you. And so, I do think they're trying to get their ducks in a row of how, as Mark said, they're going to really audit these. So, I still think it's a very viable question or concern to have going into the new year. I did someone see ask, can I take the employer retention credit if I deferred my payroll taxes? I just want to be clear. There's two ways. You deferred the employer portion of your payroll taxes, 50% to December 31st, 2021, 50% to December 31st, 2022. My first caveat to that is if you don't pay them until that time, you will lose the deduction, whether you're cash or accrual in 2020. So again, I talked to your advisor, we are very much a proponent of pushing our losses into 2020 if you're in a loss situation because of the value NOLs have in 2020 versus 2021. But essentially the answer to that question is you can have both. You can have an employer retention credit and a deferral, and the FFCRA credit. So, and the list goes on and on. So that's true.
Okay. And just a reminder, those FFCRA credits also would be an offset against PPP you would want to exclude those. I apologize to all of you that have sent in some more technical questions that would really require us to get more into the weeds and understand your situation before answering. I've tried to address the general questions we've received thus far. Will there be an updated call after this is signed by the president if there are changes? I guess it would depend on the extent of the changes. If there are significant changes in a truly new stimulus bill, yes.
And the other thing I would point out is this is our introduction call. You know, and last time when this all happened, we had an introduction call and then we had updates, right? As we keep getting into the bill and start, you know, doing some more tactical and planning, I'm sure it might not be us, but I know not-for-profit does a ton of webinars, commercial does a ton of webinars, construction does a ton of webinars, banking does a ton of webinars. We will be with you through this. We are your advisor, and we take that seriously, and we know this has been a difficult year for all. And so this is, I would say, just the beginning. Make sure you're signed up for client alerts, client insights, and obviously be talking to your advisors at the firm.
Okay.
Okay.
Everyone have a safe and enjoyable holiday season, and hopefully this early Christmas present will come to fruition.
Yeah. Merry Christmas, or today I heard is the first day of Happy Festivus. Happy Hanukkah, Happy Kwanzaa, whatever. Take a break, hopefully, with family and friends. You know, we are going to try to and be prepared, hopefully, to attack all these planning ideas and strategies to keep us going in 2021. Have a great day.
Happy holidays.